This is January 25th at 8:35 a.m. Market just opened. Here we see we did have a entry off the green diagonal line. The signal came in at looks like 7:20. That's Central Standard Time, Chicago time. The market came down to the green, and then when it on this bar here at 49.02 and a quarter, when it closed above the white moving average, and the moving average had turned up that bar. This is the beginning of a trade. And ultimately, you see what happened. The market took off. We didn't know it would move that quickly or anything, but that's the value of getting in a good place. So at this point, and that entry was a good entry, but we didn't really know where the exit would be because it's in the middle of a cluster. So technically, you would get out at any of these lines, and they're very close by. But in this case, if they're having a whole night of nothing, coming down to support finally breaking above, off of the line, both the white line and the green line, and they met here at that point. It's also kind of a timing signal. We had a rally out of it. Now, the next target up here is at 49.24.4. Didn't reach there yet. The moving average is up here at 49.11. We just came down to it. So this was actually another potential entry because it had retested the yellow, but it was far away from the moving average. So this would have been a riskier entry. But when it came back to the moving average and now it's popping back up, that would have been another way to get in. Going forward, we're looking for 29.24 as an exit. And our stop at this point, I think we can use the moving average, which is quite a bit underneath, as a close under that might be a decent stop. Remember, we got in here in the 49.02 area. Market looks happy this morning. Most of trading is waiting. It's not a whole lot to do in here. Either it goes up or it comes down. Just waiting. We never have certainties. It may or may not reach the target, but very often it does. And at this point, we have quite a bit of paper profit. So we're going to wind up winning something. Now, if you had gotten in the trade on a retest of the yellow line, which was here, you would have gotten in here at 49.13 with a target of 49.24. So you have to evaluate whether a stop at 49.09, which is underneath that bar low, having entered 49.13 is a 4-point risk. The upside target is 11 points away. So it's 11-4. It's a little less than 3-to-1 return to risk ratio on the trade. But that trade also, because the entry was pretty far away, the entry was here, moving averages down here, there's quite a bit of risk on that entry. So not everybody would necessarily find it comfortable to take that trade. I personally wouldn't. But the one at 02, I would. Because it was coming off two lines, the green one and the white one. And it had been going sideways for so long, there was potential for a move that might be more meaningful, that might smash through some of the cluster. The dark red up here, you notice it's a little darker, a little thicker than the other lines at 49.24. We call that the timing angle. It's important. If the market's below it, it's still not in a bullish position. It's like what Gann called the 45-degree line, 45-degree angle. If it goes above and closes above and stays above, then the market is turned into a more bullish mode. We just broke under the moving average with 1 minute to go left in the 5-minute bar. We're going to exit if it stays down here and the moving average stays down, but it still could pop back up, so we don't know. Well, it survived that bar. We're still in. Closes below. Again, it's challenging the moving average. The moving average is kind of sideways. If it breaks, it's 3 minutes left in the bar. We wait till it close. If it closes below, we'll get out. That will be our stop. That was just the cursor, that little white dotted line. It wasn't one of our lines. You can also see the outline of the cloud here. The market was just hanging on to the cloud. It was a little bit of, here it was below it, then it went above it. We tested it a few times, broke above it. So it broke above the cloud, broke above the moving average, but it came off of our lines here. We had the green and the white line crisscrossing. The market was right there. This is a normal bullish type pattern. Shows support based on something meaningful. Moving average moves around too much. You can't use it by itself. But if you use these lines as the reference and the moving average is kind of a filter, you get a good combo. And that's what we're depending upon. And it's working nicely. Showing resilience here. See, ultimately it came and pulled back to the moving average. It was above and came back, but this wouldn't ordinarily be a buy signal, even though it's a nice potential. If it had come all the way back to the yellow line here, it almost made it. It was about half a point away. Then that would have been another type entry because it came down to one of our lines on a pullback. Those are good entries. Then it closed above the moving average. So you would be getting in long. But it's peripheral. It's not. All we have right now is the support from the moving average as a basis, and we usually wouldn't take a trade based on only the moving average support. As tempting as it might be. We're outside of it. This is the cluster, and we're outside of it, and we're in between. And there's a one line in the middle here, which is going to be the target because it is far enough away as a potential space. We had mentioned that if the market is inside a cluster, and this is a cluster, a bunch of lines all near each other in here, that a lot of times the market will do nothing, or it'll chop around, creating a trading range type thing, which is what did happen. And then when it ran into this diagonal green line, which is, we could call it the fast timing angle, and the red one up here we'll call the slow timing angle. A lot of times this could be the trigger for another move after being, in that cluster for such a long time. Build up momentum. It built up a lot of potential energy, and then it built up a lot of potential energy, and was ready to go somewhere. In this case, it broke upward. You don't know. It doesn't tell you for sure which direction, but this one broke above the moving average, and obviously it stuck its little periscope head up here, and that was our entry. It was above the white line, came off a couple of lines that were at the bottom of the range after a sideways phase. And it was also the intersection of this green line and white line and the price being right there. That's a balance of time and price that oftentimes could be the beginning of a trend. In this case, it was. This is a 5-minute bar chart, so it's all very small. Then when it broke quickly above the yellow line, it was free. It was in between a cluster and the next line, which turns out to be in the middle between this cluster and this higher one. But that thick red line becomes the target because it's far enough away to make some money. And we don't know it's going to get there. We don't know for sure. But the probabilities are it will. And if it doesn't, we'll get out some decent profit. You never want to let a trade like this turn into a loss. You have too much win. You're up too much. You should never let it go all the way back down. For those who are interested, that white moving average seems to be pretty important. It's 22 bar exponential moving average that we're using. All the other lines are not moving averages. Those are our matrix channel lines. But this one we use as a helpful filter for the trend. And also the Ikimoku cloud we use as a trend indicator. Right now it's above the cloud, indicating it's in an up mode. It's a bullish position the market's in. So it's in a bullish position. It's above our cluster, which means it has a little bit of room and some freedom to move upward. And the next line is far enough away at 48.24 and change to be worth holding on. But right at the moment, it's challenging our moving average again. This is trading. It's all there is. You just have to sit and watch it. There's an old expression, do less and accomplish more. You could have gotten in and gotten out. You could have done a lot of things, but at this point, there's nothing definitive, and so there's no need to take action. Yeah, we had 24.25. The line's at 24.30, which you can't reach. We did it. 24.50 just happened. You're out. Trade ended. Started at 7:20. It just ended at 9:25, 2 hours and 5 minutes. 49.02 to 49.24. So that's 24 points. Market's going higher, but this trade's over. We don't ordinarily we'll get out at the line and we're not going to just chase it. Now, if you wanted to stay in the trade, you still could use the moving average underneath. You may wind up with less or more. You don't know. But it's 2 hours, $1,000, not bad. So here we have a few minutes later, we were going to get out here of our long position at 49.24. And we now see it was a good idea because this line not only held, but the market collapsed back down to the 49.12 area. It's not yet a short position because the moving average did not turn over yet. And even if it was a short position, the next line, the yellow line, is fairly close. So there really isn't much money to be made here. The bullishness of the market. Now this is the 6th day in a row the S&Ps are up. You don't want to fight that trend if you don't have to. If there was a potential to make money on the trade, yeah, but if you got short under the moving average and the moving average is turned down in here, the next line is too close to bother with. It almost reached it already, 49.12. So there's no short yet. But what is interesting is how if you had gotten out here, you did really well. Market did not go through it. It usually doesn't. It usually has trouble when it gets to these lines, particularly the timing angle. The thicker line's a little more important.